When we think about the transition into retirement, we're focused on 4 core categories. That is your retirement income, your asset allocation and location, your withdrawal strategy, and your tax plan and strategy for retirement. So let's dive into your retirement income. First, we want to identify what income are we going to have in retirement. Outside of our Social Security benefit, do we have a pension? Do we have rental income, income from a business, or are we solely relying on our portfolio income? And so once you've identified the income sources that you'll have, you then want to look at, do you have an income gap in retirement? Because if you have an income gap, that is the difference between your expenses and let's say your Social Security benefit, how are you going to fill that gap? And that's where your portfolio really comes in. So once we've identified your income gap, we must now identify how much we can actually pull from our portfolio if we're going to live a 25 to 30-year retirement. And an easy starting point is this simple equation. Calculate how much you need from your portfolio on an annual basis. What you then want to do is divide that by your portfolio balance. This will give you what we call the withdrawal rate. So for instance, if you identify that you need $20,000 per year and your portfolio has $1 million across all of the accounts, your total portfolio balance is $1 million, then we know that this is a 2% withdrawal rate. And so once we've identified that withdrawal rate, we then want to look at the asset allocation. And we do want to be mindful of where are these assets held? What does our tax situation look like? Inflation, among other things. But to keep this simple, if our portfolio in aggregate is hypothetically returning more than 2%, then we know that we will never touch our principal. And in fact, we will have compounding in our portfolio each and every year. And so this brings us into our withdrawal strategy. And traditionally speaking, we use the traditional withdrawal sequence. That is, we pull from your taxable account first, then your tax deferred account, and then finally your tax free account. That said, depending on the location of your investments, the tax allocation of your investments, your strategy might differ here. But really what we're shooting for as it relates to a withdrawal rate is anywhere from a 4.7 to a 5.5% withdrawal rate. And now, yes, it is different based on your situation. And one thing we want to keep in mind is we want this withdrawal rate to be fluid. We want it to be dynamic relative to how our portfolio is performing. And what I mean by this is let's say that we have a really good year in the market. And as a result, our portfolio continues to compound. Well, we might look at that and say, hey, for this given year, because our portfolio has done well, maybe we take more off the table in terms of our withdrawal rate, in terms of how much we're pulling from our portfolio. Now, on the flip side, if the market does poorly for a given year, maybe we adjust our withdrawal rate down so that we aren't relying as much on our portfolio and locking in those losses as we see a decrease in portfolio value. And so as we think about our withdrawal rate and our strategy and how we're pulling assets and from what accounts we're pulling assets from, this brings us into our asset allocation and asset location strategy. So let's start with our asset allocation. And typically what we do here is we allocate our portfolio into buckets based on our income needs and our goals in retirement. And so bucket number one is our liquidity bucket. These are funds that we need in the next 0 to 3 years. And so we're going to keep these in cash and cash equivalents, money market funds, and maybe CDs. And then we have bucket number two. Bucket number two is our defensive bucket. Think funds that we might need in the next 4 to 7 years. And in this bucket, we're going to have defensive stocks, dividend paying stocks, as well as bonds. And then finally, our growth bucket. Our growth bucket, ideally, we don't need these funds for 8+ years. And so therefore, they're going to be in growth-focused investments like stocks. And so what we've effectively done here is we've allocated our portfolio into these buckets to support the income that we need in retirement. And so the idea is we're never locking in a loss on our portfolio to take the income that we need throughout retirement. And so as we think about our asset allocation and the bucket investment strategy, we also want to be mindful of where these assets held. For instance, if bucket number 1 is our liquidity bucket, funds that we need in the next 0 to 3 years, and we're allocated in cash and cash equivalents, money market funds, CDs, and we're using the traditional withdrawal sequence, pulling from our taxable account first, then our tax deferred, then our tax-free account, then it might be advantageous, again, depending on your situation, to have bucket number 1 in our taxable account. Why? Because that's the account that we're pulling from first. And then we have our defensive and our growth bucket. And maybe we put those into our tax deferred and tax free bucket. Why? Because those will continue to grow tax deferred and tax free. Plus, we don't need those funds for an extended period of time. So in addition to creating a bucket investment strategy, we need to be mindful of where are these assets located and what is the most tax efficient way to pull assets and allocate assets to support our income in retirement. And this is a great segue into our tax plan and strategy for retirement. Again, depending on the tax allocation of your investments, you'll need to think about and clearly identify if strategies like Roth conversions or qualified charitable distributions, tax loss and gain harvesting are something that makes sense for your situation. At the end of the day, as it relates to your tax plan for retirement, our number one goal is, given our portfolio, given the location of our assets, is there anything that we can do from a tax perspective to increase the amount of tax-adjusted ending assets in your portfolio, in your pocket, at the end of your life?